Welcome back. In this video, I'm going to be analyzing Comcast. This is the big media company and also broadband company. And they announced their earnings on October 26th, and they provided a fresh set of financials that I could take a look at and estimate what I think the company is worth. I'm an investor in Comcast. I own shares in Comcast. I own a pretty good sized position in this company. It fits into my income portfolio because Comcast pays a dividend. I think it's at 2.7% right now. And it acts a lot like a communications company, like an AT&T or a Verizon. Yet Comcast has a far better balance sheet than both AT&T and Verizon. I'm going to be analyzing the company and making a decision on either buying more shares, just holding my shares, or selling my shares in Comcast. I'd like to show that to you. Do me a favor and like my video and subscribe to my channel. And also, please leave comments on Comcast. I'd love to hear what you think of the company, what you're doing with Comcast, if anything. Now, let me analyze Comcast. On all my stock investments, I take each stock through a process. That way, I have a consistent process over time and really take each company through the same scorecard. The first question I ask is, do I want to be a part owner in this business, and do I like this industry? Do I think the management team is doing a good job in operating the business well? Do I think the balance sheet's in good health? And it shows net debt less than 3 times EBITDA. And I want to discount the stock. I want to buy shares, and I want to see the value of those shares go up. And the clearest way to set that course is to buy a good company at a discount. And based on the answers to those questions, I will buy, hold, or sell. Comcast is mostly known because they own NBC and CNBC. If you're an investor, you probably watch CNBC to some extent. But they also own Peacock, which is streaming now. They own a big studio. Oppenheimer was one of their movies. So very well recognized for its media business. But that's only 1/3 of the business. Most of the business is actually in communications. It's in the form of Xfinity. So a lot of people, especially on the East Coast, they'll subscribe to Xfinity to get their broadband. A lot of businesses will also use Comcast services to connect their businesses, their data centers, and so forth. So 2/3 of the business is really true communications. 1/3 is more of the media that we recognize because we went and saw Oppenheimer, or we tune in to CNBC. On October 26th, Comcast announced their earnings for the third quarter of 2023, and revenues were nice and stable. They went up almost 1%, so nice and stable revenue for that quarter. Their profitability went up a little bit, which is good, and their earnings per share took a nice upward swing. For some reason, the stock really went down upon announcement of the earnings, which was a surprise, frankly. They generate really good free cash flow, and I'm going to get into free cash flow further in a few slides. So as mentioned, Comcast is 2/3 connectivity and platforms, and that means broadband, high-speed internet, connectivity services, and that business grew just a tiny bit, which is good. And keep in mind, we are somewhat heading into recession. We might be in a recession. It's kind of been a recession that we've expected, for about 2 years. So it's not bad to see that they're nice and stable and their business is not going down a lot in revenue. I see other companies that are announcing earnings and they see their revenues drop. For example, Apple, they're seeing, quarter after quarter, their revenues dropping. And I think a lot of investors are getting out of Apple. Comcast is a stable company, and their primary business is really holding steady, which is good to see. The smaller part of the business, it's about 1/3, is content and experiences. But again, we recognize it far more because it's NBC, it's CNBC, it's the movie studio that put out Oppenheimer. It's a theme park that we go and enjoy ourselves. So more recognized, but it's a smaller part of the business. And it grew just slightly. It grew up a little bit from a revenue standpoint. It was nice and profitable. Very good to see. The profits did rise nicely. And probably the star of the show here is the theme park business. It really grew nicely. Revenues grew 17%. Profitability went up 20%. Very good to see, although it's a small part of the business. Overall, the company is about a $30 billion company, and this is 2.4 billion overall revenue. But it was good to see that people are getting out there, enjoying experiences, on-site experiences where they can go to these theme parks and enjoy themselves. Comcast really drives free cash flow, and they really return that free cash flow to investors. I'd like to go over that. To begin with, they have a solid balance sheet. The free cash flow they produce enables them to keep that debt manageable. And although they carry a pretty good amount of debt, $90 billion, they have really strong EBITDA. And I annualized the run rate this year and expect that they're going to do about $39.5 billion of EBITDA. So that gives them a score of 2.3, below a 3 ratio on debt to EBITDA. So that tells me this company has a healthy balance sheet. Now, as we look at the return to capital, they return it in two ways: dividends, and they repurchase shares. And they repurchased quite a bit of shares in the last 12 months. That's really good to see. Fewer shares means that each share is going to own a greater percentage of the company. So that's a positive. And they also return dividends, and they've had a really nice upward slope on the dividend rate. So really nice to see that nice dividend. Now, I use free cash flows as one of the principal valuation methods of a company. So let me take a look at the statement of cash flows for the most recent quarter that was reported. And it reports the full 9 months of 2023. And for the first 9 months, you could see that cash from operations went up. It went up substantially, which is good. But Comcast had to put more money back into the business in the form of capital expenditures. So when you measure the net, because to get to free cash flow, you take your cash from operations and subtract those capital expenditures. It really stayed about the same. So the run rate of free cash flow, if you compare the first 9 months of 22 versus the first 9 months of 23, it stayed the same. So that's really good. I think they have very good free cash flow, and it's good that they're holding it at the same level while investing more money into the business. I believe that Comcast is discounted by 16%. I think that each share is worth about $50.27, but it's being sold for $43.18. I get to this value using two methods. First is the free cash flow method, and I'm using last year's free cash flow as a starting point, which was $15.7 billion. And I showed you that free cash flows for the first 9 months is the same. And I'm going to grow that free cash by 3% in the first initial 4 years. After the fourth year, all cash flows after year 4 are going to grow at 3% and establish terminal value. I'm going to discount all those free cash flows I expect the company is going to produce in the future by 8.5% as a weighted average cost of capital. And that shows me that the net present value of all those free cash flows is going to be $283 billion. I'm going to add the cash on balance sheet and take away the debt. That gives me a equity value that's available on Comcast of $192 billion. The market cap for Comcast currently is $173.8 billion, and the difference from the stock price value that I calculate based on free cash flows and the stock value that the market's selling shares at gives you an 8% discount on Comcast. Earnings per share is another method that I use, and the earnings per share that's expected for the full year 2024 is $4.29, and I'm going to use that. Historically, this industry, communications, has a PE of 18, so I'm going to go with that PE ratio, and a growth rate of 3%. And based on the discounting of earnings per share and using this formula, I get to a earnings per share value of Comcast stock of $57.76, but the market will sell you shares at $43. So earnings per share actually gives a more favorable discount on Comcast. I put more weight in free cash flow. I put 2/3 of my weight on free cash flow method and 1/3 on the earnings per share method. So when I blend those two, I get to that 16% discount on Comcast stock. Comcast stock for year to date is up 23.48%, which is really good considering that they're more of a stable company and they have had a nice upward trajectory in their stock price over the last year. So that's really good. The dividend that they pay is 2.73%. And what's interesting is the market did not like the earnings. You saw this huge collapse after the earnings, but it really rallied back really to where it started. So that was interesting to see. I have I think a modest discount calculated on the stock. So there's still some upside in the stock, although it's not a ton of upside. And it has experienced a really nice upward trend. So it's been a good year for Comcast stockholders. Now making a decision whether I should put more of my hard-earned money into Comcast stock or if I should sell the shares. Let me go through that. So first, do I want to be part owner in this business? And do I think the industry is good to invest in? Yes. I think Comcast, especially their communications business, to me, I like stable stocks in my income portfolio. They pay a nice dividend. They return capital also in the form of buybacks. And the industry is good. It's an industry that broadband's not going to go anywhere. You know, this connectivity, it's, if anything, it's growing. Everybody's streaming a lot more, really working at home. All those factors really enable Comcast to continue to grow and be important to our economy. So I like the industry. I like the company. And their management team's doing an excellent job. I like that they really focus on keeping that balance sheet healthy. It really separates them from AT&T and Verizon. And if you look at their balance sheets, they're terrible. But this is the best balance sheet if you are looking for a good communications company. Which leads me to debt. Debt is less than 3x EBITDA, so it has a healthy balance sheet. They generate tremendous EBITDA and very good free cash flow. They have a small discount, and not big enough for me to say that they get the check mark for a discount. I like seeing discounts, you know, above 25%. 25% is probably my minimum. And as you saw the jaggedness of the volatility in Comcast, even though this is a stable industry, you can usually catch stocks when they get sold off. Good example would be Meta. Meta was sold off tremendously. You could have bought Meta in the $80, $85 range about a year ago, and today it trades at 300 per share. So that's what I'm looking for. Is I'm looking for a healthy discount. Comcast is not offering that currently. That said, I'm going to hold my shares in Comcast. I think the company's really good. I'm going to hold my position, keep collecting that dividend. And if the stock goes down in price, I might change my rating and start buying shares. If the stock rallies and rallies too far above where I value the stock, I may need to trim back my position or sell all my shares in Comcast. So that's my video and analysis on Comcast. I hope you enjoyed it. Leave me a comment. I'd love to hear what you think of Comcast and what you think of Comcast competition. Would love to hear comments around that. And do me a favor and like my video and subscribe to my channel. I'd really appreciate that. Good luck investing in 2023.